Joining us now, first on CNBC, is Carnival Corporation CEO Josh Weinstein. It's good to have you back. It sounds like you're another healthy report card on demand for cruising.
Yeah, you got it right. We just finished our third quarter. Our yields were up over 4.5%, nicely over guidance. Guests are enjoying what we have to offer. We have 8 world-class brands that are all doing amazing things all over the world, and it shows in the results. It shows in the guidance that we just took up again, as you said, for the third time this year, over 5% yields for the year, and that's pretty much all on same ship sales. It's not getting juiced by new ships. It's really us performing very well across the board.
How far does your visibility go into booking? How far into 2026 can you see?
We're about 50% booked for 2026 already. We're about 2/3 booked for the next 12 months. And so the visibility is quite good. And the consumers are looking for great experiences at great value, and that's what we have to offer.
The stock's down 5%. I guess high expectations has to filter in there. Have you heard anything else from investors?
Actually, no. All we've been hearing is great support. It's improvement across the board. It's higher revenue. It's lower cost. Our returns just hit 13% ROIC for the first time in almost 20 years. We had record net income this quarter. It's the 10th quarter in a row we have record revenues. EBITDA and operating income on a unit basis, the highest in 20 years. So I can't say how proud I am of the team, because they've been performing amazingly.
Josh, we keep hearing from the airlines that to the degree that there is weakness, it's main cabin oriented. Lots of macro charts floating around looking at the lower cohort weakness in either cash piles at the household level or wage growth. Is there nothing at the low end of the price spectrum that did show some softening?
Well, in the third quarter, Carnival Cruise Line, which is our biggest brand and certainly the most well-known in this country, their booking volumes were 8% higher year over year. And when you look at our portfolio, the top 2 returning brands in our entire portfolio, Carnival and AIDA being a contemporary brand for Germany and Carnival being the contemporary brand for the United States. So there's strength really in the whole portfolio because of the value that we get to bring.
What about pricing growth? Does that mean it holds up into next year, as we've seen in 25, because of this demand?
Well, as we said, our book position is pretty much in line year over year, and it's at higher prices, and that's both with our North America brands and our European brands. So the strength is there across the board.
What do you think is driving it? I feel like we've talked a lot, Josh, and you've always said it's the comparison to land-based vacations on land, the value proposition there. Is that still a big differential?
Oh, I think it's a huge driver. I mean, in the grand scheme of things, if you line up a land-based alternative to one of our cruises, you will get so much more value for the price you're paying. You will pay less and you will get more. And really over the years, our brands have been doing a better and better job of getting out in the consideration set of consumers. We're not competing with other cruise companies for cruise business. We are a tiny piece of the vacation market, and we are absolutely competing for the vacation dollar, so that instead of going to Orlando or a beach resort or going land-based trip to Europe, you're going to come with us. We're going to take you on an amazing cruise experience that is really going to knock your socks off. And that's what we've been doing for the last several years, and we see that trajectory continuing. And as good as we are doing in improving our yields, getting more price for what we have to offer, that gap is still enormous. So we get to use it as a sword and a shield.